If you put the exact same amount of money into a 401k and a Roth IRA every single month for 30 years, both accounts will show you the exact same number on the screen when you retire. But here's the part almost nobody explains correctly. One of those numbers is real money you get to keep, and the other one has a silent partner waiting to take a cut. The IRS. By the end of this video, you're going to know exactly which account puts more real, spendable dollars in your pocket, and it depends on something most financial YouTubers never even mention. Stick around, because the answer might genuinely surprise you. Hey, welcome back. Today we're settling this debate once and for all with actual numbers, not just general advice. Here's what we're covering: what a 401k and a Roth IRA actually are in plain English. The one tax concept that decides which account wins for you specifically. A real dollar-for-dollar math example so you can see it with your own eyes. Why your employer match changes everything. And a simple strategy that lets you get the benefits of both. This isn't going to be one of those videos that just says, "It depends," and leaves you hanging. I'm going to give you a clear framework so you can make this decision for your own situation by the end of the video. Let's get into it. Let's do a quick, no-fluff breakdown. A 401k is a retirement account offered through your employer. The money you put in comes out of your paycheck before taxes are calculated. So if you earn $60,000 a year and you put $6,000 into your 401k, the IRS only taxes you on $54,000 that year. That lowers your tax bill right now, today. But, and this is key, when you retire and start pulling money out of that 401k, every single dollar you withdraw is taxed as regular income. The government let you skip the tax line now, but they're waiting for you at the exit. A Roth IRA works in the completely opposite direction. You contribute money after it's already been taxed. So that same $6,000, you pay taxes on it first, then it goes into the account. There's no tax break today. But here's the magic. When you retire, every dollar you take out, including decades of investment growth, comes out completely tax-free. Not reduced, not partially taxed. Zero taxes, forever, as long as you follow the rules. That's the entire foundation. Now let's talk about why this difference matters way more than people realize. Here's the concept that determines which account actually makes you more money. Your tax bracket today versus your tax bracket in retirement. Think about it like this. The government is basically offering you a deal. Pay your taxes now at your current tax rate, or pay your taxes later at your future tax rate. Your choice. So the entire question becomes, do you think your tax rate will be higher or lower when you retire? Let's use real numbers. Say you're a single filer making $70,000 a year. A big chunk of your income falls into the 22% federal tax bracket. Now fast forward to retirement. Let's say you're pulling $50,000 a year from your accounts to live on. That might put you in something closer to the 12% bracket, because tax brackets are based on total income, and most retirees have less income than they did while working. If that's your situation, the math clearly favors the 401k. Why? Because you're avoiding a 22% tax hit today, and instead paying a lower 12% tax hit later. You're literally arbitraging the tax code in your favor. But now flip the script. Let's say you're 24 years old, just starting your career, making $40,000 a year. You're in the 12% bracket right now, but you're ambitious. In 20 years, you expect to be making real money. And by retirement, you expect a comfortable lifestyle that puts you in the 22% or even 24% bracket. In that case, the Roth IRA wins. You lock in that cheap 12% tax rate today while it's low, and you never pay taxes again, even if your future tax bracket is much higher. This is the single biggest factor in this whole decision. Not fees, not investment options, your tax bracket now versus later. Okay, let's stop talking theory and actually run the numbers, because this is where it gets interesting. Let's say you're 30 years old, and you contribute $500 a month to either account for 30 years until you're 60. We'll assume a 7% average annual return, which is a reasonable long-term estimate for a diversified stock portfolio. After 30 years, both accounts grow to roughly the same pile, $566,000. Same contributions, same growth rate, same balance. So far, it looks like a tie. But now let's actually withdraw the money, because a number on a screen isn't the same as money in your bank account. Scenario A, 401k, taxed at 12% in retirement. You withdraw the full $566,000 over time. The IRS takes their 12% cut on withdrawals. That leaves you with roughly $498,000 in real spendable money. Scenario B, Roth IRA, same $566,000 balance. Withdrawals are tax-free. You keep the entire $566,000. In this scenario, the Roth IRA left you $68,000 richer, just from the tax treatment alone, with identical contributions and identical growth. Now, let's flip it. Let's say instead your tax rate in your working years was 22%, and in retirement it drops to 12%. Scenario A, 401k. You avoided paying 22% tax on that $500 a month while you were working. Because you skipped a higher tax rate, you effectively had more money available to invest along the way, which compounds. Run that forward 30 years, and the 401k actually pulls ahead by a similar margin because you avoided the more expensive tax bracket. The takeaway: the account that wins isn't fixed. It completely flips depending on whether your tax rate goes up or down between now and retirement. Now here's something that overrides basically all of this math: the employer match. If your job offers a 401k match, say they match 50% of your contributions up to 6% of your salary, that match is free money. It's an instant, guaranteed 50% return before your investments even do anything. No Roth IRA, no investment strategy, no market return can compete with free money from your employer. So here's the actual priority order almost every financial advisor agrees on. First, contribute enough to your 401 tax to get the full employer match. Always, no exceptions. Then, if you expect your tax rate to be lower in retirement, or you just want tax diversification, fund a Roth IRA. Then go back and max out the rest of your 401k if you still have money to invest. Skipping your employer match to put more into a Roth IRA is one of the most common and costly mistakes people make with this decision. Let's make this concrete with a few real-life profiles. Profile 1, early career, lower income. You're 23, making $45,000, expecting your income to grow significantly over your career. Roth IRA is likely your best bet. You're in a low bracket now, and you lock that rate in forever. Profile 2, high earner, peak career years. You're 45, making $180,000 in one of the highest tax brackets you'll ever be in. A traditional 411 probably makes more sense. You get a big tax deduction now while your rate is high, and you'll likely be in a lower bracket in retirement. Profile 3, uncertain future. You genuinely don't know what tax brackets will look like in 20 to 30 years. And honestly, neither does anyone else, because tax law changes. In this case, splitting your contributions between both account types gives you flexibility no matter which direction tax rates move. Here's something a lot of people don't realize. You're allowed to contribute to both a 401k and a Roth IRA in the same year, as long as you stay under the contribution limits for each. This is called tax diversification, and it's honestly one of the smartest moves you can make because it hedges against the biggest unknown in this whole equation: what tax rates will actually look like decades from now. If tax rates go up in the future, your Roth IRA money is protected. If your income drops significantly in retirement, your 401k withdrawals get taxed at a lower rate anyway. Either way, you built in flexibility. A common approach: contribute enough to your 401k to get the full match, then fund a Roth IRA, then go back and add more to your 401k if you have room left in your budget. Let's bring this all together. 401k, tax break now, tax later. Wins if your tax rate will be lower in retirement than it is today. Roth IRA, taxed now, tax-free later. Wins if your tax rate will be higher in retirement than it is today. Always get your full employer match first. That's free money, full stop. If you're not sure which direction your taxes are headed, splitting contributions between both protects you either way. There's no single, correct answer that applies to everyone. But now you actually understand the math behind the decision, instead of just guessing. If this video helped clear things up, hit subscribe. I break down real personal finance math like this every week, no fluff, no sponsored nonsense. And drop a comment below: are you Team 401k or Team Roth? I'll pin the best breakdown. See you in the next one.